Hi guys, Jared Johnson here. We are going to continue the option discussion and this time talk a little bit about credit spreads. Now, again, in these videos, there's a lot of option strategies. There's a lot of details that we can discuss and go through, and we'll go through them as we progress through the videos. But what I want to make sure everyone understands is I'm going to first and foremost kind of focus on the strategies I use the most that I think are pretty common strategies and are ones that probably need to be discussed the most heavily. So we're going to talk about credit spreads. Now, there are credit spreads and debit spreads. They're called a whole bunch of different things. You'll hear about vertical spreads. You'll hear about short put verticals, short call verticals, long put verticals, long call verticals, debit spreads, credit spreads. There's all these kinds of different names, right? We're going to focus on the credit spread side of things. I don't trade debit spreads too often, although it's a decent strategy. I do like credit spreads because they're a low risk, easy to make money strategy. And this goes back to the idea that we talked about in the earlier videos of selling calls and selling puts, right? Being on the sell side. So if you remember that discussion, being on the sell side, remember, if I buy a call option, then what I want the stock to do is go up. That's how I'm going to make money. That would be called buying a call option or being long a call option, right? So if I'm buying or long a call option, I want that stock to go higher. That's how I'm going to make money. That's how this trade's going to work out for me. Well, if I'm doing this side of things over here, where we are short the call, right? If I'm short a call option, then what I really want is, and of course this is short or, oops, there we go, selling or short a call option, then what I want to have happen is I'm taking the other side of that trade, and I actually want the stock to go down, right? Because if I'm buying or long a call option, I'm paying for an option. I'm buying an option at a lower price and hoping to sell it at a higher price. That's how I'm going to make my money. If I'm short a call option here, then I'm actually getting paid to get into the trade, and I'm hoping to buy my way out for a lesser amount than I was paid to get in. If I paid $100, if the option buyer here pays $100 for their call option, that $100 minus a little bit of money for the broker to keep is coming into my pocket as the option seller. So I'm paid $100 to get into this trade. But what happens next is dependent on what the market does. If the stock goes down and the option loses value, that's good for me because I was paid $100 for the option. If it's losing value, I can buy my way out for $70, $60, $50, or $0, and I get to keep all that money. If the stock goes up and the option value increases, then I was paid $100 to get in, and I might have to pay $150 to get out. So then I'm giving all my $100 back plus a $50 loss, for example. So remember, when we're long an option, in this case, a call option, I want the stock to go up. If I'm short a call option, then I want the stock to go down. So that's just a little reminder, a little discussion of what we covered in the video about option buying versus option selling. Now remember, same thing, so a couple of things to kind of keep an eye on. Typically, buying a call option is bullish, buying a put option is bearish. But when we're short a put option or short a call option, meaning I'm a put seller or a call seller, then I want the opposite to happen. If I'm short a put, I want the market to go up. If I'm short a call, I want the market to go down. And that's where a lot of people can get confused in option trading. They say, okay, I just got clear that if I buy a call option, that's bullish. If I buy a put option, that's bearish, and that's correct. But if you sell a put option or you're short the put option right here, you want the market to go up. If you sell a call option or you're short a call option, you want the market to go down. Everybody good with that? So today we're going to talk about these infamous credit spreads and why I love them. So strictly speaking, with credit spreads, we have a bull put spread and a bear call spread. And they have a lot of different names. Again, a bull put spread might be called a short put vertical. It might be called a short put spread, a bearish or a bullish put spread. I mean, you know, they got a couple of names for them, but a bull put spread and a bear call spread means exactly that. On a bull put spread, what do I want the market to do? Go up. On a bear call spread, what do I want the market to do? Go down. So these are low risk, easy opportunities for profit spreads that we can trade in a market that's moving. Now, the way that this is going to work, let's just look over here, for example, and the way that this can and should play out, right, is that when I look at a stock and I say to myself, okay, this stock looks like it's, you know, it's making a move for me. Let's see what we need to do here. Then we determine, you know, what kind of spread we want to trade. Now, as a full disclosure, I very rarely trade any kind of bearish call spreads. I don't like those because they don't give us the kind of flexibility that I like to see on, you know, that we have with like a bullish put spread. Because with bullish put spread, we have a lot of good things that we can do with that if the trade, so to speak, doesn't work out. And we'll talk about that in future videos. But for the most part, what I want to see happen is I want to see how, you know, how we can work with these bullish put spreads versus these bearish call spreads. But before all of that, here's a couple of things. Here's kind of the mechanics or the functions of these. If I look at this, you know, I'm on United Steel here, right? U.S. Steel, just a good old stock, steelmaker stock. I'm looking at this one and I say, okay, you know, this has been in an uptrend, and I think it's going to stay in that uptrend and continue higher. So what am I going to do? You know, of course, I have the option to either buy a call option, I can buy the stock, or I could trade a bullish put spread. And a bullish put spread would say, maybe I go out 2 or 3 weeks, and I would sell a higher priced put, and I would buy a lower priced put. So basically what this means is, this is my trade right here. I'm selling that higher price put. In this example, let's just say hypothetically here, and it's not so hypothetical because we're right there. Let's say I'm selling the, you know, $18 put, right? So I, whoops, hold on here. So I sell to open $18 put. So this is our concept here. I'm going to sell to open that $18 put, and then I might do something like this, buy to open the $17 put, right? So that would be a credit spread. That would be a bullish put spread. So what I'm really hoping with a normal typical credit spread is that the market can stay above $18 at expiration. And if it does, then my sell to open put will expire worthless. Let's say I was paid $150 to sell this option. That's going to expire worthless, and I'm going to keep $150. But likewise, my buy to open put will also expire worthless. Now, that one I had to pay for. So remember, when we're option buyers, we have to buy the option. We pay a certain amount of money out, and we hope to, you know, make some money on that, right? But when we're option sellers, we're paid. We receive an option premium to take the trade on, and we're hoping that that option goes to zero, so we don't have to buy our way out of it. We're paid to get in, and we buy our way out. And the lesser amount we buy our way out for, the more money we get to keep. So if at expiration, the market is above my highest strike here, my sell to open put. That sell to open put, I might have been paid $150 for that. That's going to expire worthless. I get to keep $150. But my protection, this lower strike here, this lower option is my protection. And I'm going to lose that money, right? I'm going to lose that amount that I paid there. But in the case of a credit spread, the lower strike price, like this $17 put, costs us less money than the higher strike price costs, or than we're paid for the higher strike price. So I might pay out $100 for my protection, which I'm going to lose, but I get paid $150 for my short put or my sell to open put. And so I get to keep the $50. Here's an example. I actually have a trade on U.S. Steel right down here. So this expires in 2 weeks. I actually, in this case, sold, that little -1 means I sold the $19 put, and I bought, that regular one means I bought the $18 put. So you can see in this example here, I was paid, this negative number right here means that was money I received. I was paid $135 to sell that $19 put, but for my protection, I had to pay out $86. So the maximum amount of money I can make on this trade is 49 bucks. Because if I lose all $86, that's going to come out of the $135 that I was paid. So my protection comes out of the profit I'm getting, which is 135 bucks. If I lose 86, that leaves me with $49 in profit. So that's how that works. That's how that kind of general situation is going to function for us. So when I look at that and I say, okay, that's how a put spread works. Now, a couple other important items of business here is, why do we have this protection? Well, we have this protection because if, oops, there we go. If the market goes like this, right? If instead of this just, sorry, my mouse is sticking like crazy. Instead of this dipping down and heading up like that, which is great, if it doesn't do that, the market might actually, you never know, we could have another big violent sell-off for whatever reason. We could see the market go like this, right? And if that happens, my buy to open $17 put, my protection kicks in, and I don't end up losing a ton of money, right? So what will happen is, in this case right here, remember, when I'm short a put, I want the market to go up. So the market going up is good, means I get to keep all my credit received. Everything's good, but I'm going to lose this money right here, this 86 bucks. Well, if the market goes down, if US Steel here goes down to 10 bucks or 12 bucks or whatever, if it just drops off the planet, which it could do, if it just goes crazy and goes straight down, then this option is going to start making a bunch of money. Now, you can see that my trade's against me a little bit, right? And I can see that because I paid $86 for this protection, and it's actually worth $102.50 right now. So I'm actually up about $16 on that protection. If this just continues to go down and down and down, this is going to continue to gain and gain and gain, while this continues to lose, right? I'm going to continue to lose money on my short put, but I'll be making money on my long put, or my buy to open put, to offset that loss. So the most money I can make on this trade, just being a basic put spread, not doing any major changes to it, the most money I can make on this is $49 per contract. If I'm in one contract, I make 49 bucks. If I'm in two contracts, I make 49 times 2. If I'm in 50 contracts, I make $49 times 50 contracts, right? So you can make some good money on these. And all it has to do is just stay above 19 bucks. You know, it doesn't need to do anything real super specific, just stay somewhere up there above 19 bucks. If this, on the other hand, makes a big drop down, then like I said, my long put is going to be gaining and my short put will be losing. So what's the most amount of money I can lose? Well, the way that we calculate that is we look at the distance between the two strike prices. In this case, I had a buy to open at $18 and a sell to open at $19. So there's essentially $1 in between that. Now, everything in options is always, you know, multiply by 100, right? Because every option contract has 100 options in it. So I look at that and I go, okay, I multiply that by 100, so there's $100 in between 18 and 19, right? 100 potential dollars. There's one actual dollar, but, you know, multiply that by 100 options per contract, there's $100 in between them. So if I was paid $49 overall for this spread, and again, that's getting paid $135, and that's paying out 86 bucks for protection. So if my overall take is $49, then what I do is I take the distance between these two strikes and I subtract the premium, 49 bucks, and the remaining amount is my risk. So if I can make $49, the most money I can lose on this is 51. Hopefully that makes sense to everybody. So when we're calculating what our risk is on option spreads, I'm going to do exactly this right here. I'm going to calculate the distance between strikes less the premium received. That's our risk, right? So once again, the distance between here is $1. You could say that I received 49 cents per option, which is true, or $49 per contract. So I received 49 cents per option, leaving me 51 cents remaining, which is my risk. So 49 times 100, 51 times 100, so I get paid $49 per contract, and I risk $51 per contract. So I can't lose more than $51 on this trade. If this stock literally goes bankrupt and goes to zero, I'm out $51 per contract. Now, the downside is if this stock goes straight to the moon, maybe the stock goes up to $200, can't make more than $49 because I'm selling an option, and option profits, we receive a certain amount in the beginning and we cannot make more money than that. I cannot make more than $135 a contract. I just can't do it. Now, if I'm buying an option, yes, I can make a lot of money if a stock goes straight up, but I'm also taking a lot of risk. So this is how a credit spread works. To put it in simple terms, this is exactly what we're looking for. Again, you know, the purpose of these videos is not to go through all the real technical, intense, hard option stuff. It's to say, here's a credit spread. Here's how it works. I'm going to sell an $18 put. I'm going to sell a higher price put, and I'm going to buy a lower price put. Just the next strike down. If the stock price ends up above these two strike prices, anywhere up here, I get to keep my maximum profit, which in the case of U.S. Steel, $49 per contract. If it ends up at expiration below the two strike prices, I'm going to lose the maximum amount, which in this case, since I received $49 between these two strikes and there's a $51 risk, I could lose $51 if we end up below these two strikes. So that's a little bit of how those credit spreads work and how we're going to use these. Now, it would be just the opposite with a bearish call spread. Again, I don't trade bearish call spreads very much or almost ever, but it would be the exact opposite of what we just talked about with a put spread. So with a bullish put spread, I'm selling the higher strike and buying the lower. In this case, with this bearish call spread, I'm doing just the opposite. I'm buying the higher call option strike price, and I'm selling the lower call option strike price. So in this example here, I'm buying to open an $18 call, and I'm selling to open a $17 call. And again, just the exact same thing as we talked about. It's just the opposite here. If at expiration, the stock price is below these two strikes, I make the maximum amount of money. And it would be the same concept, right? If there's $1 between the two strikes and I make $50 getting in, I'm risking $50 if it doesn't work. If at expiration the stock price is above the two strikes, then I'm going to lose the maximum amount of, you know, in this case, we'll say $50, right? Very, very simple. That's how a call spread works. That's how a put spread works. Call spread, we're selling that lower price, buying that high price. In a put spread, we're buying the lower price and selling the higher price. So in this case right here, a bearish call spread is bearish, right? This is what a bearish call spread is. I want it to go down. A bullish put spread is bullish, and I want the stock to go up. Credit spreads are one of my favorite strategies. I use them on almost all trades, but I put a lot of little tweaks on these credit spreads so that we can make them maximally profitable. But I wanted to give you guys some general ideas of how we're going to trade these and what we can do with credit spreads. They're really great. I'll give you one more kind of last thought before we wrap it up. A typical strategy, if you're trading a bullish put spread or a bearish call spread, whatever it might be, number one, expirations of 2 to 3 weeks are pretty good. Number two, get in, if we're bullish, we're going to put a bullish put spread 1 strike below current stock price. And if we're bearish, we're going to do 1 strike above current stock price. Right? So that kind of gets you started on, on how to get going with these spreads, how to kind of look at some of this stuff and how to use it. But yes, I mean, I'm just going to go 2 to 3 weeks out. If I'm in a bullish spread, I'm going to put my strike my strikes, you know, if the stock's trading at $18.25, I'm going to go just one strike below at $17.50 or $18 right in that area. And I'm going to sell to open that put, and then I'll go one strike below that and buy to open my put. If I'm bearish, then I would just be, you know, again, a little bit up here. I would sell to open one strike above current stock price, and I would buy to open one strike above that. Okay, guys, I hope that's helpful. That's a little introduction to what credit spreads are and how we're going to use them. We're going to use them like crazy. So I hope that's helpful. Thanks, everybody.